If silver doesn't just go to the norm of 2%, which it's been 20 years of the last 50, and does what it did during the bull trends, if you go back and look at that spread relationship in 79 to 80, it was 6.5%. Or in 2010 to 11, it reached over 3%. That's a doubling from where it is right now. Okay, so instead of 2% of the price of $8,000 gold, let's say, assuming gold only does the norm, what about 3%? What about 6%? Which is what it did in the last two bull markets. We're in a bull market now. I don't think silver is going to ever collapse again. It may collapse from, let's say it goes to $400 in 6 months and drops back to 250. Yeah, it'll collapse. But going back down to this old reality is not going to occur. It's leaving it. It's going to much higher levels.
The long-running discussion around silver has frequently highlighted allegations of price suppression, including past regulatory cases and enforcement actions tied to market misconduct. While this history provides important context, Michael Oliver has consistently argued that the dominant force shaping the market today is not legacy manipulation narratives, but a deep structural imbalance. For several years, silver has operated in a persistent supply deficit, yet prices remained anchored within an outdated range. According to Oliver's framework, this disconnect allowed underlying pressure to accumulate, creating conditions where any eventual response by the market would be abrupt and decisive rather than slow and orderly. What differentiates the current environment, as Michael Oliver emphasizes, is the durability and non-cyclical nature of demand. Silver has evolved beyond its traditional role as a secondary industrial metal and now sits at the core of fast-growing sectors such as solar power, advanced electronics, data centers, and broader electrification trends. These applications are essential rather than optional, and silver's unique conductive and physical properties limit meaningful substitution. On the supply side, years of subdued prices discouraged capital investment, leaving production growth unable to match rising consumption. Oliver notes that when markets ignore sustained deficits for too long, the eventual repricing tends to be compressed in time, as prices attempt to realign with long-term fundamentals that were previously dismissed. From a broader historical perspective, Michael Oliver draws parallels with other assets that remained trapped in obsolete price regimes while related markets advanced. Gold itself has exhibited repeated cycles where extended consolidation was followed by powerful moves that reset valuation norms rather than revisit past lows. Silver now appears to be undergoing a comparable transition, breaking free not only from its former trading boundaries, but also recalibrating its long-standing relationship with gold. In such phases, Oliver cautions that conventional indicators often lose relevance, volatility intensifies, and sharp price movements should be viewed less as instability and more as evidence of a market adjusting toward a higher and more realistic equilibrium. Now, we present the clips from Michael Oliver's interview. Before we continue, please subscribe to our channel and activate the bell icon to receive timely updates. Thank you, and enjoy the video.
I don't know what's been restraining silver, except that we do know there has been deliberate attempt to keep it down, banks and so forth. And I think there's actually been some convictions, and marketplace convictions, the Justice Department and so forth, of attempted several years ago of attempt to, manipulate the market. So, but we don't analyze silver from that point of view, the fundamentals. So we know we have a supply-demand deficit. We've had that for 5 years. Why is silver only now responding? Well, pent up pressures. The ongoing demand by China, essential for their solar panels. They're 80-90% of the global solar panel production, and silver is essential in that. And also, we hear all about these AI data center, power centers, so forth. Well, silver is essential in that. Here, there, and everywhere, in micro form and larger form. You can't get rid of it. It's essential because of its nature of the metal. And so those demand factors are continuing to grow, and it's not been priced into silver, the supply-demand issue. And so if it's made an error in not already responding to that by incremental growth to respond to that ongoing demand, which it's not done, then when it catches up, it just does it in a maniac way. And actually, it's rational because it gets from point A to point B where it should have been anyway, perhaps 10, 20 years ago, and does it in a lightning form. And copper did it, lead did it, gold does it every bull market. In fact, a point about gold right now, the mama metal. It's not a primarily industrial, it's primary money, okay. You had of the last 50 years since the government legalized it, quote unquote, you had the bull market It peaked in 2000, but dropped into 1975 when it was legalized. As soon as it was legalized, it peaked and dropped to $103 in mid 1976. That was a bear low, 50% pullback. From that 76 low at 103, it went to 850 in 3.5 years. Eightfold gain, bear low, bull high. Then for multiple decades, it went sideways, but where? The $200, $300, $400 level, okay? Well off the 850 high, but still way above the old reality that prevailed in the 1970s and so forth. In 2001, it made a low at around $260. And a decade later, it was 1920, another eightfold move, bear low, bull high, under conditions that aren't anywhere approaching the fundamental realities that are now underlying gold. Okay. Gold's bear low this time was in 2015 at 1,050. Eightfold, so somewhere about 8,500. Okay. We're 4,500. We're only a fourfold move. We're only half the dimension of the prior two bull markets. What if gold does it again? Which is hardly like a shocking thing to have another eightfold move. Okay, big deal. Wow. Where would silver be if, let's say, silver now rushes up to, let's say, 2% even, an ounce of gold? Oh, wow. What would that be? 8,000 gold, 2%? You get the point. What if gold doesn't stop at its old eightfold move again because something different's going on this time? And what if silver, instead of going to where it's been in the last 50 years, that relationship has at least been 2% in 20 of the last 50 years. Divide silver into gold, at least been 2%. We saw a low this year at about 1%. Dirt cheap, free silver compared to gold, okay? If silver doesn't just go to the norm of 2%, which it's been 20 years of the last 50, and does what it did during the bull trends, if you go back and look at that spread relationship in 79 to 80, it was 6.5%. Or in 2010 to 11, it reached over 3%. That's a doubling from where it is right now. Okay, so instead of 2% of the price of $8,000 gold, let's say, assuming gold only does the norm, what about 3%? What about 6%? Which is what it did in the last two bull markets. We're in a bull market now, so wouldn't the spread go up and at least challenge the spread relationship it had in 1980, 2011? Heck, prices above those highs. Why shouldn't maybe the spread relationship also go up and challenge those highs? So the ceilings come off silver, both in its relationship to gold and its own technical situation. So it's a monster. And if you don't treat it that way, and if you treat it like, oh, RSI is overdone, you'll miss the move. In fact, the fact is that if you do monthly RSI, a popular so-called momentum metric, we ignore it, but it's popular. In the 79 to 80 move, RSI on a monthly basis got above 80%, which is the upper, overbought level, for a year. So when it first got to 80%, if you said, oh, I'm out, it's overbought, you missed the entire move. From like the teens to 50. Okay, you missed the whole move. So take your norms, throw them out the window. We're not in a normal situation. That's our assessment. And admittedly, yes, if we get what we expect in the next 6 months, then yes, we'll be more cautious about perhaps locking in, especially leverage positions or call option positions. I don't think silver is going to ever collapse again. It may collapse from, let's say it goes to $400 in 6 months and drops back to 250. Yeah, it'll collapse. But going back down to this old reality is not going to occur. It's leaving it. It's going to much higher levels. And if you're not there for the next 6 months, I think you're going to miss it.
Recent developments in global markets are putting gold and silver squarely in the spotlight, with investors increasingly questioning the stability of conventional financial systems. In his latest market analysis, Michael Oliver highlights that while both metals have experienced strong rallies, these moves are occurring within a far larger structural shift that has been building for years. He notes that short-term pullbacks are not only likely, but should be expected after rapid price advances. Yet these dips are often opportunities to reposition rather than signs of long-term weakness. Oliver emphasizes that silver, in particular, has entered an explosive phase where momentum can accelerate quickly, making timing critical. He also points out that traditional technical signals may not fully capture the magnitude of this transition, and those who treat these movements as normal risk missing the bigger picture of what could be a historic revaluation cycle. Michael Oliver further connects the surge in precious metals to mounting stress in sovereign debt markets and the broader financial system. with governments and central banks increasingly intervening to stabilize bond yields. Doubts are growing about the reliability of fiat currency and debt instruments. Oliver underscores that gold and silver are now benefiting from a fundamental shift in investor behavior. Capital is moving toward real assets that exist outside the debt-based system, offering protection against the erosion of money's purchasing power. This dynamic creates conditions for sharp price swings, not as a reflection of market irrationality, but as a natural response to systemic imbalance. According to Oliver, these metals are uniquely positioned to thrive in an environment of fiscal uncertainty, with silver poised for dramatic gains relative to gold as the market recalibrates to reflect the true scarcity and value of physical assets.
It's quite a few, quote, dollars, arithmetically speaking, above the breakout over $50, where the spread was when it broke out. But it's really just begun. And now, 6 months from now, you can't say that. But I think now you can say that. It's still not too late, because silver valuation to gold is off the page, still dirt cheap. And the spread technicals tell us that historically, silver's on its way to a rampage versus gold. So even if gold just goes up to the normal high of 8,000 and takes you 6 months to get there, and everybody says, oh, that's got to be the top. Well, it's matched. It's done it twice before. Maybe it's going to be different this time. We got a crisis on our hands of major proportions. This time we got government debt crisis. Here, Japan, UK, etc., where the government bonds, the core of the asset world, could come into doubt. And, like President Williams of the New York Fed in mid-November made a speech or a press conference, and he said the Fed is going to start buying bonds. And his explanation for that was, and we know they've been, because you look at what they've been doing lately, they've been buying the hell out of, okay. He said only because of illiquidity in that market. Not because they're afraid it's going to collapse, but because, and rates explode, but illiquidity. That's a nice way to avoid the issue. But they're very concerned about it. The Japanese are too. I mean, we have a government, we don't have a mortgage crisis this time. We have government debt, and that is bigger than the entire US stock market. And they've been buying and buying and buying since November, and bonds have gone nowhere except sideways. And our assessment of T-bonds right now, which is the quiet one, watch out for him. But he wakes up, he could do violent things. It's been 118 to 114 and a half for since November. Right now we're trading at 116. All they're buying has not boosted the bonds. They've just gone dead sideways in price, meaning the yields on 30-year are at the highs, just sitting there, not breaking back down. No relief on long-term debt. And subgroups in the stock market, like commercial real estate, which is a huge subgroup, which is a very anemic sector, has been going sideways in the middle for the last year, in the middle of its 10-year range. It hasn't made new highs with the S&P. It hasn't broken down yet. And everybody thinks, oh, well, it hasn't broken down. It must be okay. Watch the T-bonds, because if they roll over, like they're 116 now, you don't ever want to see 111 again. Look at a price chart and say, well, we've seen 110. What's the big deal about 111? Our momentum structures say you go there, you're going to get an implosion. Now, admittedly, they're going to come out with fire hoses. Bank of Japan, Fed, et cetera. Central banks are going to go ape, and they're going to print money like crazy. Well, what's the beneficiary of them destroying the money in it? Gold, silver, real money benefits from the decay of fiat money. And that's the history of gold and silver as well. So that's the other wave underneath here. And watch the T-bonds, because if they can't control that market and it slips just a handful of points on the T-bond futures, we're looking at March futures right now, 30-year bonds. They're at 116. You don't want to slip off even a couple of points, especially 4 points, because they're going to blow the bottom out of it. You're going to have a panic in the bond market, which is not on anybody's horizon right now. Everybody's looking at what's NVIDIA doing. Okay. Who cares? Yeah, NVIDIA ultimately is going to pay the debt for being the excessive sector, the AI sector, but it probably won't be the provoking one. And frankly, right now, we view the stock market as stable and likely on an intermediate basis to probably even go up a little bit more. Maybe get well into the first quarter before you see any rollover at all. And I don't see, by the way, what a lot of gold miners, investors are afraid of. Oh, if the stock market goes down, we go down. No, it doesn't. A few times in history, gold and miners suffered. October of 2008 is the most conspicuous single standout month, where the stock market already a year off of its bull market high, already substantially off of its bull market high, which was October of 2007. Okay, so October 2008, it had what you could call a crash month. And gold and silver joined, and so did the miners. And gold turned around within a few months, was back to the high, new highs. Stock market continued down through 2009. But what happened after that crash in October of 2008, which gold was ripe for a correction at that point, by the way. It had been going up massively for years. And so it was due for a nice sharp break. And so it had one. And everybody thought, oh, man, it's the end of gold. No, in a matter of months, it was back making new highs, and S&P continued down. So that myth ended. Yes, there was a 1 month that stood out as in sync. But look what happened January through April. Gold rose, stock market broke down this year. How come gold didn't collapse? Gold went up. Like, what did gold do? It peaked in April, 3,500. Stock market made a low. They weren't in sync. I don't think the stock market in the U.S. is about to have a crash type event. I think what's more likely to happen in our assessment of the S&P and the NASDAQ is that this upside crawling effort that we've had for like 4 months now, where every month you get the S&P up over 6,900 and it sells off but doesn't go anywhere, 6,900, 4 months in a row. I think you'll probably get over 7,000 and go on. Who knows? Maybe we get a decision from the Supreme Court on Friday that says, we're going to block the tariffs in some way. And the market thinks, oh boy, it goes up. It doesn't look right technically to roll over yet. And when it does roll over, I don't see the danger of a rapid rollover at this point. I'm suspecting you're going to have to get into the second quarter before the S&P ever gets back down to numbers that we would define as, the bottom comes out. And those numbers are down well below where we are right now. We're going to get in the mid 5,000s again, like 5,600, before you trigger numbers that say, okay, I can implode. And so, I think the S&P is likely to go up for a few more months, which means, hey, if you're in gold miners, no problem from the stock market, if you believe in that correlation myth, which is very few examples in history validate that, by the way. And even when it does roll over, I don't see it being sudden and dramatic until you get back down toward those levels. Remember, in April, we got to 4,800 on the S&P. I'm saying if you get back down now to 5,600 anytime this year, the floor could come out. But that's a long way down there, and the process of getting there could be laborious, meaning not panicky, which means probably if you're using that as your scare thought, that I'm in gold miners and I got to be scared of the stock market, I wouldn't be scared. I don't think you're going to get drama out of the stock market on the downside until you get back to that level, and that could be a process. We may be well into the 6-month period of the silver explosion, with miners also exploding. And the stock market's still just copacetic and no threat to the miners. Anyway, that's my thought on that issue, is that the stock market's not a threat right now. It is a threat if you're an investor. I don't think you should be long the stock market. I think it's topping. It's been topping since January, and I think the new highs are just teaser highs, which also occurred in 2000 and in 2007, where you look like you topped and made a new high by about 10, 15%. And then, a year later, you fell apart. Anyway, so from an asset point of view, if you're in miners as a category, and I emphasize them right now too, I think they're going to beat gold going forward this year. I think they're going to be the better place to be than gold is, just like silver is going to be better than gold. But I don't think the stock market is a threat to them at this time.
Looking ahead, the trajectory for gold and silver points to continued strength, driven by both structural demand and systemic uncertainty in global finance. Supply constraints, particularly in silver, are likely to keep upward pressure on prices as industrial and technological use expands faster than mining output. Investors may see intermittent corrections along the way, but these are expected to be short-lived pauses rather than reversals, as the underlying forces pushing metals higher remain firmly in place. The current environment favors those who focus on long-term positioning, capturing opportunities during temporary dips rather than trying to time every short-term swing. Meanwhile, gold is expected to maintain its role as a hedge against currency and debt instability, with demand from both institutional and retail participants continuing to rise. The widening gap between real assets and traditional paper-based instruments signals a broader reallocation of capital, which could amplify gains for metals over the coming months. Market volatility is likely to increase, but this is part of a recalibration rather than a breakdown. Silver, in particular, is poised for outsized performance relative to gold as industrial necessity and scarcity converge. suggesting that the next phase of this metals cycle could see rapid and significant price acceleration that redefines long-term valuations. Let us know what you think in the comments. And if this video offered new insight, don't forget to like, share, and subscribe for more updates on this unfolding monetary revolution.